Hey everyone, it's John here. The reason you're watching this video is that you want to grow your wealth. The first step to achieving this is understanding a fundamental concept, the difference between assets and liabilities. Assets put money into your pocket while liabilities take money out. Think of it like this. An asset is like a money-making machine, consistently generating income, while a liability is like a drain, constantly sucking money away. The more assets you have working for you, the wealthier you become. So today, we're diving deep into the world of wealth building by exploring 8 different asset classes that the wealthy use to grow their wealth. Let's kick things off with the most liquid asset, cash. Now, I know what you're thinking. Cash, it just sits there, losing value to inflation, but hold on, cash still plays a crucial role in wealth building, especially for those who want to seize opportunities quickly. Think about it. When a once-in-a-lifetime investment opportunity presents itself, you need to act fast. That's where cash comes in. Take Apple, for example. They have over $150 billion in cash reserves, giving them the agility to make strategic investments or acquisitions whenever the right opportunity arises. But cash isn't just about big players like Apple, it's about you and me too. Having a healthy cash reserve allows you to take advantage of unexpected opportunities, whether it's investing in a friend's promising startup or grabbing that incredible deal on a rental property. Sure, a traditional savings account might not yield impressive returns, but have you considered peer-to-peer lending platforms? These platforms connect borrowers directly with lenders, cutting out the middleman and allowing you to earn significantly higher interest rates. Remember, even with cash, it's about finding the right balance between liquidity and return. Now let's move on to a favorite asset class among the wealthy: real estate. Real estate has long been considered a reliable path to building wealth, and for a good reason. It offers 2 powerful wealth-building mechanisms: rental income and appreciation. Owning rental properties is like having your own personal money printing machine. Every month, your tenants pay you rent, providing a steady stream of passive income that flows directly into your pocket. And as rental rates tend to increase over time, your cash flow grows even more substantial. Real estate also has the potential to appreciate in value over time. As populations grow and demand for housing increases, the limited supply of land drives up property values. When it comes to real estate investing, you have options. You can invest in residential properties like single-family homes, duplexes, or apartment buildings. Or you can explore commercial real estate such as office spaces, retail stores, or industrial warehouses. Each type of property comes with its own set of advantages and risks, so it's crucial to research and find what aligns best with your investment goals and risk tolerance. Let's shift gears now and talk about bonds. In simple terms, a bond is like lending money to a government or a corporation. You lend them your money for a set period, and in return they promise to pay you regular interest payments known as coupons and return your principal investment when the bond matures. Bonds are generally considered lower risk investments compared to stocks. This makes bonds an attractive option for conservative investors looking for a predictable income stream and capital preservation. While the returns on bonds might not be as high as those from stocks, they offer a level of stability that can be comforting during market volatility. Think of bonds as the slow and steady tortoise in the race to financial freedom. They might not win every sprint, but they consistently move you closer to the finish line. Typically, bonds yield around 3% per year, which might not seem like much in today's market. However, remember that this is a relatively low-risk return, and when you factor in the power of compounding over time, even these seemingly modest returns can grow into a significant nest egg. Now, let's talk about stocks, the asset class that often comes to mind when people think about building wealth. Unlike bonds, which represent debt, stocks represent ownership in a company. When you buy a share of stock, you're essentially becoming a part owner of that company, albeit a tiny one, and as a shareholder, you get to participate in the company's success. This means that as the company grows its profits, increases its revenue, and expands its market share, the value of your shares is likely to increase as well. This increase in value is known as capital appreciation, and it's one of the primary ways investors make money in the stock market. Many companies also pay out a portion of their profits to shareholders in the form of dividends. Dividends are like little bonuses that companies give to their investors, rewarding them for their ownership and loyalty. Historically, the stock market has returned an average of around 10% per year over the long term. However, this potential for high returns comes with higher risk, so it's crucial to approach stock investing with a long-term mindset and a well-diversified portfolio. Now, I know what you're thinking. Investing in individual stocks sounds risky, but don't worry, there's a more accessible and less intimidating way to invest in the stock market. Mutual funds and index funds. These investment vehicles pool money from multiple investors, including individual investors like you and me, to purchase a diversified portfolio of stocks or bonds. Index funds, in particular, are designed to track the performance of a specific market index, such as the S&P 500. When you invest in an index fund, you're essentially buying a tiny slice of the entire market, giving you instant diversification and exposure to a wide range of companies. One of the most significant advantages of index funds is their low costs. Because they passively track an index, they don't require active management by a team of expensive analysts. This means lower fees for investors, which can have a significant impact on your returns over the long term. Chapter 6. The income-generating power of equipment. Now, let's move beyond traditional financial assets and explore a different type of asset: equipment. Any tool or machinery that helps you generate income can be considered an asset. For example, a tractor is an asset for a farmer because it allows them to cultivate their land and harvest their crops more efficiently, ultimately leading to higher yields and increased income. Similarly, a laptop is an asset for a programmer because it's the tool they use to write code, develop software, and generate income through their skills. Even a car can be considered an asset if it's used for income-generating purposes, like for Uber or Lyft drivers. The key takeaway here is that for equipment to be considered an asset, it must directly contribute to income generation. Investing in high-quality, reliable equipment can be a smart financial decision, improving your productivity and efficiency and increasing your earning potential. Chapter 7. Protecting your ideas, the value of patents. Let's dive into the world of intellectual property and explore the fascinating realm of patents. Patents are legal documents that grant inventors exclusive rights to their inventions for a limited period, typically 20 years. They serve as a powerful tool for protecting intellectual property and preventing others from making, using, selling, or importing your inventions without your permission. Patents can be incredibly valuable assets, especially if the invention they protect gains widespread popularity or solves a significant problem. Think about it. If you invent the next groundbreaking technology, a life-saving medical device, or even a wildly popular toy, a patent ensures that you reap the financial rewards of your creativity and hard work. One of the most well-known examples of a patent generating massive wealth is the Slinky toy. This simple yet ingenious invention has sold over 300 million units worldwide, generating billions of dollars in revenue for its creators. The patent protected the Slinky's unique design and prevented competitors from copying it, allowing its inventors to capitalize on its immense popularity. The beauty of patents is that they provide multiple avenues for generating income, such as licensing your patent to other companies or selling it outright. Chapter 8. Trademarks, building brand recognition, and generating revenue. Now, let's move on to another essential form of intellectual property: trademarks. While patents protect inventions, trademarks safeguard the symbols, names, and slogans that businesses use to identify their goods or services and distinguish themselves from competitors. Think about some of the most iconic brands in the world: Apple, Nike, Coca-Cola. What do they all have in common? Instantly recognizable trademarks. Apple's Bitten Apple logo, Nike's swoosh, and Coca-Cola's distinctive script are all trademarks that have become synonymous with their respective brands, representing quality, innovation, and a certain lifestyle. Trademarks are incredibly valuable assets because they embody a brand's reputation, customer loyalty, and market share. A strong trademark can command premium prices for products or services, attract top talent, and foster trust among consumers. Just like patents, trademarks can be licensed to other businesses, generating a steady stream of passive income. For instance, if you own a trademark for a popular clothing design or a catchy slogan, you can license it to other apparel companies, allowing them to use your trademark on their products in exchange for royalty payments. Chapter 9. Building your financial fortress. So there you have it, 8 powerful asset classes that can help you build lasting wealth. Building wealth is a long-term game that requires patience, discipline, and a strategic approach. Focus on acquiring income-generating assets that work hard for you, even while you sleep, whether it's real estate, stocks, bonds, intellectual property, or a combination of different asset classes. The key is to create a diversified portfolio that aligns with your risk tolerance and financial goals. By consistently making smart financial decisions and leveraging the power of assets, you can secure your financial future and achieve your financial dreams.